said, and we'll have, while I chair it, around the state of the economy. We have, under the Humphrey-Hawkins Act, and I should note, I think, well, I guess I have before, but I'm not sure this is the first or the second Humphrey-Hawkins hearing we've had since Gus Hawkins passed away at the age of 100, a really great man, and the value of the act becomes all the clearer. As I look at the European Central Bank with its mandate only to deal with inflation, and our central bank with its dual mandate to deal with inflation and high employment mandated by the Humphrey-Hawkins Act, I am again reminded, I think, of the wisdom of Gus Hawkins and Hubert Humphrey, because I think we are well served by the duality of that mandate compared to what the ECB does. But it was my view that in addition to hearing from the Chairman of the Federal Reserve Board, we ought to hear from other voices as well on the economy, and that's the purpose of this hearing. Tomorrow, Chairman Bernanke will testify before this committee. On Thursday, he'll testify before the Senate. But this is part of a process by which we solicit other views. I think the Federal Reserve is a very well-run institution. We have a former member here of the board. But I also believe that it gets, in general, more intellectual and political deference than is healthy in a democracy. It is often considered to be the case that it's legitimate for us in the democratic fora to debate war and peace and the physical future of the universe and the most intimate questions of human conduct. But if any politician dare talk about 25 basis points on the interest rate, that is somehow a great breach of the rules and could cause terrible consequences. That's nonsense. Monetary policy is a legitimate subject for debate, as well as any other, as long as it's conducted in a sensible way. It's particularly the case this particular period, because what we are seeing are, I think, the limits and constraints that the Federal Reserve faces in monetary policy. And I think, let me announce a change of mind. Some time ago, when we talked about the multiplicity of federal regulators in the banking area, a common subject, one question I raised was, well, why does the Federal Reserve need to be a bank regulator? We have all these other bank regulators. Why can't they just be the monetary authority, as is the case in other places? And Alan Greenspan said at the time, and I was skeptical, but I now acknowledge he was right, that being the regulator informs the Fed's judgment about the economy in ways that help in the formulation of monetary policy. The problem, I must say, is that I do not think Chairman Greenspan fully followed through on this, because I think what we have is a disconnect between the Fed's authority as a regulator and its role in monetary policy, essentially for ideological reasons. Under Chairman Greenspan, the Federal Reserve consciously decided not to exercise a great deal of its regulatory authority. That's now changing under Mr. Bernanke. I don't think that's been adequately commented on. For example, in 1994, Congress passed the Homeowners Equity Protection Act to give the Federal Reserve regulatory authority over all mortgages, not just those issued by depository institutions. Chairman Greenspan consciously and deliberately decided not to enforce that, not to use that authority. When the Control of the Currency and the Office of Thrift Supervision issued their federal preemption of a lot of state consumer protection laws, including some in the mortgage area, one response was to beef up what the Control of the Currency could do with regard to consumer protection. I spoke at that point to the late Ned Gramlich, who was the Federal Reserve Governor with that responsibility. He said, well, here's what you need to do. Under the Federal Trade Act, the Federal Reserve System has the authority to promulgate a code of unfair and deceptive practices for the banks. That would be a replacement for some of the state consumer laws that were knocked out. I said, well, that's good. Why are we not doing that? He said Chairman Greenspan is opposed to that. He thinks that is too much regulation. We wrote, some of us, to the chairman, and he said no, he wasn't going to do that. Mr. Bernanke, I think, is again going to reverse that decision. And I believe under Chairman Bernanke, you are going to see an exercise of authority to promulgate that code that we didn't have before. The relevance of that is this. I think there has been a tendency to look at monetary policy as the macro sector of the economy, and financial regulation was micro. But the micro has decisively influenced the macro. We have a macroeconomic crisis today, clearly at least the worst financial crisis in the world since 1998, and its impact in the U.S. conceivably worse than 1998. And the single greatest cause, obviously all phenomena in a complex world have multiple causes, but the single greatest cause is regulatory failure. The single greatest cause of the current economic crisis is the failure of federal regulators, in particular in the United States, to use regulatory authority. The result has been not just the subprime crisis, but the infection of the entire credit system by the subprime crisis. And both the fact that mortgage loans were made that should not have been made in the absence of any sensible regulation, and the fact that those loans were then allowed to spread in various ways that were obviously not fully understood throughout the system, is the single biggest cause of why we are here. So what we are talking about today is, and in consequence, a number of people know that monetary policy is somewhat constrained. And I do know Chairman Greenspan generally, both during the dot-com issue and the irrationally exuberant stock market, to quote the chairman at the time, and today, Chairman Greenspan's inclination was to pose this choice. Either I deflate the entire economy, or I allow these phenomena to continue. And, of course, the answer to that dilemma is sensible regulation. If you have inadequate regulation of abuses, yes, then you do get to a situation where your choice is deflation of the entire economy or allowing the abuses to flourish. And that's why, in the current context in particular, sensible consideration of monetary policy requires looking at the role of regulation. Because in the absence of regulation, you give monetary policy too heavy a lift, one that it conceptually and intellectually cannot make. And that's what I believe we will inevitably be talking about. I've reviewed much of the testimony, and not surprisingly, many of the witnesses, in fact, make that point. The problem we face today is a problem of inadequate regulation, of an innovation, securitization, a good thing, because innovations that don't serve some positive role die of their own lack of merit, but innovation that outstripped any regulation, and the consequent problems that we've had have led us to where we are. So as I said, in this case, while we are talking about monetary policy under the Humphrey-Hawkins Act, or the economy in general, we are talking about, in my judgment, the role that inadequate regulation has played in causing a dilemma for the monetary policy makers. And that's what we will be talking about today, and we will be talking about it with the chairman tomorrow, Gentleman from Alabama.